Welcome back. 11,950 on the Nifty, but let's connect with Neelotpal Sahai, Head of Equities at HSBC Global Asset Management, to talk about the way ahead for the markets as well as what's going to be the next big trigger. And thank you so much for joining in. I think based on the calendar of events, everything's going to culminate next year. And that's particularly going to be the budget, where the expectations are rife that something needs to be done when it comes to tweaking of the personal income tax. Do you think that, if the government does oblige, that's going to come across as a big game changer? There's lots more that needs to be done in order to revive the economy.
Yeah, thank you very much, and good morning, everyone. Yeah, I think I also do believe is that a lot of expectations are riding high on the forthcoming budget, which is now less than 50 days away. Given that there has been a change in sentiment after the corporate tax cut, and a series of announcements in the last month also with respect to setting of real estate fund, with respect to the Supreme Court judgment in the NCLT case, or the divestment of the PSUs. So there has been positive change in the sentiment in the markets after the government announcement, and which is why the expectations are riding high from the union budget. But by and large, most of these announcements had been with respect to supply side. However, the broader understanding right now is that the slowdown in the economy is not linked to the supply side, but rather the slowing down of the demand side. And something needs to be done with respect to revival of demand, especially in the rural areas. Of course, urban is also important, but rural has slowed down even faster than the urban consumption. And which is why probably a cut in direct taxes, probably some other kind of stimulus with respect to demand revival, both in urban and mostly for the rural consumption, is what market would be looking for, and that would be positive from the economy perspective as well.
Okay, in terms of, if you are seeing that kind of pickup coming in this morning, we had some positive commentary coming in on liquidity from N. Chandrasekharan, as well as an actual demand from Anand Mahindra as well. Do you see the situation changing, let's say, in the next 3 to 6 months? What's the kind of timeline you're looking at?
So we have seen some improvement in the festival season, but one is not very sure whether how much sustainable those kind of revival is, because more high frequency data is not supportive of the overall revival. There has been like one-off cases with respect to the e-commerce or the festival season auto sales or so. We have to see more data, more high frequency data to really make a call and make a base case assumption that the demand is on the revival upswing. As of now, there may be green shoots here and there, but this is not by and large the base case assumption. So it might be 2 quarters, it might be 4 quarters also. So that's what we are not too sure of. A lot will actually ride high on what kind of stimulus is there in the budget, what kind of improvement is there in the jobs market, in the wage growth market, and maybe next year monsoon also will be important. This year's monsoon was positive, and hence Rabi crop production, as and when it comes, this is likely to be on the positive side. So that will help, that will benefit. But these are necessary conditions, but not sufficient condition for us to call for a demand revival at that stage.
I'm taking a look as to which are the sectors that you're bullish on, and the one that stands out is telecom. In an environment where day after day we have a whole host of corporate voices within the telecom universe, talking about how the AGR issue is a big one, how there need to be 3 players, there's mounting losses, there's stress on the balance sheet, the debt as well is piling up. What makes you stick your neck out and bet on telecom?
Yeah, so if you look at the telecom sector, there has been a complete erosion of profit from this sector earlier on account of fragmentation, and later on account of higher capex intensity. But we are at a point of time where the capex intensity is likely to moderate, except for the AGR issue, a capex for the business purposes. And also we are at a stage after the recent increase in the tariffs is that the operating metrics is also likely to improve. So we are coming from a situation when there were 10-player market, the profit was on downswing, capex was on the upswing to a stage where it's a 3-player market. Capex is likely to moderate and operating metrics definitely is going to improve. It's a first among the many tariff hikes we will likely see over next few years, and that's why we believe that the profitability for the sector will come back. It's important to stay with the leaders in this sector because that's where the profit pool will migrate to as and when the profit comes to this sector. So we are positive on this sector and especially on the leaders in this sector.
What else is looking attractive? Let's talk about real estate, housing. We're seeing more further consolidation when it comes to some of the players there. Is that a pocket that you're looking at?
Yeah, so that's real estate is another sector that we are positive on. So let's split into two parts, residential real estate and commercial real estate. There's a different dynamics at play in residential real estate and in commercial real estate. Whereas there is excess supply and lower demand in residential real estate, opposite is true when it comes to commercial real estate. There the supply is limited, has been constrained over last few years, and demand has been increasing over few years, and capacity utilization in excess of 95% is also not unheard of in this sector in certain micro markets. So when we say real estate, we are more positive on the commercial real estate. But having said that, there has been an improvement in the dynamics of the residential real estate also. If you look at the affordability of this in this sector, this is at the lowest point since 2004 or so. Also, we have seen there is a decline in the nominal real estate in the there's a decline in the nominal interest rate in the system, and that has led to and will likely lead to an improvement of the condition for the developers. Also, recently there has been a government support in this sector. They have set up a real estate fund that should lead to an improvement in the situation for these sectors, and beleaguered developers should be able to do well. So we are positive on the real estate sector, mostly on the commercial real estate, and definitely those players which are leaders in the respective micro markets and the local markets. But the situation for the residential is also improving by the day.
Let's also get in a sense as to what the outlook is on the energy space, given the kind of news that we've seen with respect to divestment. If we're talking about some of the OMCs, crude price movement on some of the oil and gas names, Reliance Industries, of course, has been seeing quite a healthy move off late with respect to what Jio is doing, the retail side, and what could potentially happen for their petchem business. What's the view on energy?
So energy sector, especially in the public sector energy space, that's not a sector that we are positive on. That's not a sector we have been positive in the past as well. And that is likely, that is only because of one reason, is that the poor capital allocation in the past has led to lower incremental profit, and this is a trend that we have seen over in the near term or the longer term period. If you look at last 3 to 5 years or even a 10-year period, we have seen a consistent decline in the return ratios in this sector, and increasing missed capital allocation will lead to a further profit erosion. Of course, the things could likely change if there is a successful disinvestment of a PSU entity in that case. So in that case, it will no longer remain a public sector energy company, then probably we'll have a look at that.
Okay, I just want to take a look as to what's holding out in the markets at the current juncture. It's a positive breath. You've got the broader universe as well playing catch up with the frontliners today. So not a bad start, and we're continuing there. There's Magma FinCorp, Motilal Oswal, something like Aavas Financiers that's active. Tata Global Beverages and Yes Bank, despite all of the uncertainty regarding its fundraising, that's currently at 44 rupees, 3% higher. Kolte Patil, Hindustan Copper, as well as Shrey and Motilal Oswal are some of the other high flyers in today's trading session. What about the mid-caps? What is it that you're advising at the current juncture? We have seen the mid-cap valuation over the last years correct quite substantially. But what's the cue for investors given the kind of dichotomy that we're seeing with the overall macro setup?
Yeah, sure. Yeah, that's a fair question. So from the highs of the early 2018, when the mid caps had gone to almost 60% premium to the P multiple of the large caps, Nifty Ps, they are now at a discount. Now mid caps are at a discount of almost 15 to 17% to large caps, and small caps are at a discount to of almost 25 to 30% with respect to the large caps. But having said that, we have also seen is that the profit has remained concentrated among the largest caps or the sector leaders, and the profit growth or anticipated profit growth in the mid and small caps is still elusive. This will likely remain elusive till the time the economy begins to accelerate. Typically what we have seen is that when the economy growth is stagnating or when it is decelerating, then there is a profit pool migration towards the larger caps. But when the overall profit pool pie is increasing, then obviously the large caps do benefit, but mid and small cap do benefit disproportionately higher, and that's when they begin to do a lot better than the large caps. In the current macro setup, where the overall economy growth is weak and likely to remain weak for 2 to 4 quarters till the demand picks up, we'll probably see that the profit pool concentration towards the larger cap. But however, valuation is not something one can ignore. So our advice to the investors at this point of time would be something like a multi-cap portfolio with a mixture of higher proportion of large caps and about 1/3 to 1/4 into mid-cap and small caps.
Thanks very much for joining in. Pleasure having you with us on the show, talking about your overall market outlook, a glimpse of the macros, as well as which sectors you're bullish on.